Hi traders, welcome back. My name is Marco Meyer from Trading Educators, and today I'm going to talk a bit about stop losses, and I'm just going to give you my thoughts on this topic. So there's no 100% right or wrong way to do it, but I found some ways don't work well, while others tend to actually work pretty well, and that's what I'm going to talk about today. So the most novice way to place your stop probably is to say, okay, you have a certain market, you know where your entry is, you know where you want to get in. Let's say you want to get in here. This is the DAX future 5-minute chart. And let's say you want to buy at 96.55. And to figure out where to put your stop, you think about how much you want to risk. So let's say you want to risk $500 on this trade. And now you decide, okay, let's see where I have to put my stop. And you come out with about 40 ticks, which would fit to your risk level. Of course, that's not a good way to place your stop, simply because the market is not going to care for your stop at all, meaning if a market fluctuates that much, it's just going to take out your stop loss. Your stop is not based on what the market's doing, your stop is not based on what your strategy backtests tell you. It's not based on any statistics about the market you're trading and the time frame. It's just based on your account, your P&L, and your personal risk level. And this usually never works out logically because there's no relation between the market and your $500 actually. So a much better way to do this, and that's what most advanced traders do, or let's say a little bit more advanced traders, they tend to pick a certain price level on a chart where they might want to put their stop and say, okay, I'm going to put my stop down here. Below swing low is a popular thing to do. See how much risk I have, and then go ahead and say, okay, I'm going to trade that many contracts so that it fits to my percentage. And if it's too much, I'm not going to make the trade or make the trade in another contract. In this case, you could use the mini DAX. But still, this approach is quite novice because what you're doing here is you say, okay, I'm going to look at a chart, think about where to put the stop, and then do it that way. But it's just based on your subjective impression looking at a price chart. It's not based on any statistics. It's not based on what the market's behavior is. It's not based on how your strategy is going to perform if you do this all the time. So this is better than the first approach, but still far from perfect. Now there's a lot more to talk about, but one more thing I like to mention here is another popular technique that usually doesn't work, and that's the so-called break-even stop, where let's say you decide you want to get into a market at a certain price, let's say at this line, price trade through the price, so you get triggered in here. Now price, as you can see, moves quite nicely your way. So once it's up here, you decide, okay, I'm going to put my stop loss to break even. So you put it exactly at this price where you got in. And like in this case, you get stopped out there, and that's pretty much exactly where the market reverses again and then really takes off. I've seen this happening so often in my trades. Of course, I decided to do some back tests on it and see if it makes any sense to use a break-even stop. And let me tell you that it very, very rarely does. Actually, I have no strategy at all at the moment where I use something like a break-even stop. Now I know that it feels very good to say, okay, once I'm in profit, I don't want to lose any money on this anymore, so that I have a free trade and then I can just see if it rides my way or not. So I'm just going to put it at break even so it can't lose any money anymore, and that of course makes me feel good, and it totally does. But unfortunately, in trading you don't get paid for feeling good. I wish it would be otherwise, but the truth is that most of the things that work well are those that don't feel very good. Putting a stop to break even usually doesn't make a lot of sense. I mean, this is a good example. If you decide to trade a breakout out of this range, let's say, and the market breaks out, and now you move your stop to break even right here, the odds are quite high the market's going to go back there and test that level at least, right? This is actually where I would like to get in the trade and not get stopped out of it. And when you start to move your stop to break even, what you do again is you trade your account P&L. You no longer trade the market, right? Because from a market perspective, Is this where you would like to get out of the trade? In my opinion, totally not. Now, as a systematic trader, I'm going to give you some ideas about how I tend to decide where and how to put a stop. Here's an example we're going to look now at, just for the sake of having some example. That's the New Zealand dollar future traded at the CME. And it shows us the daily volatility of a 5-period average true range in US dollars during the last about 5 years. There are periods where this market just moves about $500, $700 per day, and there are periods where it moves almost $2,500. Then there are periods where it moves about $1,500 and so on. Now, if you decide to take an absolute stop loss level, do you think it makes sense to have do you need a $2,000 stop down here at that period where the market is not very volatile? Or does it make any sense to have a $500 stop during a period like this where it moves about $2,000 a day? I don't think so. It just doesn't make any sense. So you have to adjust your stop loss to the ongoing volatility in the market. So let's have a quick look how I like to decide on stop losses, or at least get a good idea about them depending on the kind of method I trade. We're going to use the ambush trading method, trading the New Zealand dollar, just trading one contract from 2011 till yesterday. No commissions included, and I'm going to use no stop here so that we can get the numbers we want to get. So we got about 350 trades, and we're going to look at these now. And the reason why I didn't put in a stop loss at all is to get that kind of statistic. This is telling me, first of all, the result of each trade. So each one of these dots you see here is a single trade. So each one represents one trade, the result of one trade. Now the green ones, like this one, are positive trades, and looking on the left scale we can see how much it made. So this one made about $1,400. While this one made about $1,000, and the red ones are losing trades, so this one would have lost about $1,700. The lower scale, the X scale, tells us how much did the trade go against us. So this trade, for example, here, that made us about $1,400, went against us about $300. Another example would be this one. This was negative up to $1,300 and then ended up as a losing trade of about $600. Now again, this just shows the thing in US dollars, and it's not very helpful because volatility changes all the time. So what I like to look at instead is the same statistics, just showing us the R's, meaning 1 R represents 1 time the average true range of the daily price chart. And this way I can measure it against that and then decide on what kind of stop makes actually sense. So this trade, for example, made us about 1.5 times the average true range and went against us during the trade almost 0.9 R. So that's a pretty good example of a trade that actually we had to suffer through quite some losses during the day, almost 1 time the average true range. But then it actually came back strongly and we made about 1.25 R. So let's say I decide to put my stop right here. All the trades you see on the right, I would cut off where they are. So it would be losses of 0.3 R. If I move it further to about 1, things are going to look better. All I'm going to miss out are these ones. But then, as you can see, there's still quite a couple of trades, like this one, for example, where yes, it went against us 1.4 times the average true range, but then it closed just about 0.6. Instead of losing 1.4 R or 1 R, where we would have put the stop, we lost a lot less. So trading ambush, looking not just at this one market, not just at the New Zealand dollar, but at all markets, I figured out that a good point to place a stop is about 1.5 times the average true range. Now, of course, what we figured out here only works and only is true for ambush. For another trading method, you might need very different stop losses or technique to exit your trades. This was just an example to show you how I like to approach it, and what I think is a much better way than to just look at the price chart and then to guess at where to put your stop. do the work, do the back tests, or go through your past trades to figure out what makes sense and what doesn't make sense in regard to the stop loss, because quite often it's one of the areas that really makes the difference between a break-even trader and a winning trader. Alright, thanks for listening. If you have any questions, just send me an email to marco@tradingeducators.com. Visit our website, check out the free members area we have there, where you can also join our trading forum, where you can ask questions and discuss topics like this. It's completely free and we'd love to see you join our trading community.